All right. So looking into the next part of S corporation or S company. So let's look into this and let's get a good idea about the second part of the question here. In the previous class, we had done the first part wherein we had finished the preconditions and also we had finished the four ratios. So four ratios and preconditions were done. What would be needed? What are the preconditions that we needed and also the four ratios. In this class, we look into the eight audit risks. So, and along with the audit risk, audit response. So if you look into the breakdown of the question, we have to also not only tell the audit risk, but we have to also tell the auditor's response. Okay, to each risk in the planning of the audit of S company. Okay, in the planning of the audit of S company, we have to not only tell the audit risk, we have to also tell the auditor's response. Okay, we have to not only tell the audit risk, we have to also tell the auditor's response. Yeah, both these things we have to tell. Not only the audit risk, but also the auditor's response. Right? So this is what we are looking to do in this particular question. Give an idea, get an idea about the audit risk and also the auditor's response. Okay, so let's look into this and let's close this particular part of the question, that is part C. So we'll start off now on this question. So as we read through the question here, we would realize that on 1st July, it is 1st July 2005, and you're an audit supervisor of Bangkok and Bannock Co. and are responsible for the planning of a new client. So see, ESK is a new client. So whenever new client, you found out the risk. So ESK is a new client. Okay, ESK is a new client. ESK is a new client. What is ESK? ESK is a new client. So whenever there's a new client is a risk. Okay, new client is a risk. Why is it a risk? Okay, new client is a risk. We've identified the risk. Now explaining why it is a risk. It is a risk because see, the team is not familiar with the business policies, internal controls, and also the accounting policies and the transactions. And the auditor also not audited the prior year data, the prior year financial statements, so they did not know if the opening numbers are correct or wrong. So that is why a new client is a risk. So what you can do over here, that there's higher detection risk. In this particular case, the impact is higher detection risk, and there can be possible misstatements of the opening balances. Your opening balances might be misstated, and what this would do is affect the reliability of the current year financial statement. What this would do is this would affect the reliability of the current year financial statement. So as an auditor, what you have to do, you have to assign an experienced team, provide detailed planning and risk briefings, obtain an understanding of the business, and perform a lot of additional procedures on the opening balances. Okay, on the opening balances, perform the additional procedures, and along with that, obtain an understanding of the business and assign an experienced team, provide detailed planning and risk briefing, obtain an understanding of the business, and perform additional audit procedures on the opening balances. That is the auditor's action. So first you have to identify the risk, that is the new audit client, then have to explain why it is a risk, so that the audit team has limited knowledge of the business internal controls and accounting policy. You have to look into the impact here, as a higher detection risk and possible misstatement of opening balances. And finally, auditor's action. Assign an experienced audit team and provide detailed planning and risk briefing. Obtain an understanding of the business. Okay, so that is about the new client. So when ESCO is a new audit client, so the audit team has a limited knowledge of its business, accounting policies and internal controls from a new client perspective. The impact is there's higher detection risk and possible misstatement in the opening balances. What is the auditor's action? You will assign an experienced audit team, provide detailed planning and risk briefings, and obtain an understanding of the business. Okay, and also we will obtain an understanding of the business, and we should also perform an additional audit procedures on opening balances. Okay, that is all about the new client. We identify whenever there's a new client, there's a risk. What is the risk? That the audit team has limited knowledge of the business. So what is the impact? There's high detection risk, and what we can do, send an experienced team, and along with that, form additional procedures of the opening balances and give sufficient time for understanding the organization. So that is all about this. In the case of the new client. So whenever you see new client, you know that in case of new client, there's always a risk. Okay. In case of new client, you know, always there is a risk. Okay. In case of new client, there is always a risk. Okay, in case of a new client, there is always a risk. Okay, moving on now slowly as we read forward here. Okay, so your audit manager recently met with the finance director of ESCO and provided you with the following information. Okay, ESCO is a manufacturer and wholesaler. It operates from two warehouses which are situated in north and south of the country. Extract from the forecast are as follows. Okay, there are some numbers for the ratios. So now they say ESCO has purchased a patent which gives an exclusive right to manufacture a disposal for 4-year period. The purchase cost capitalized comprises the cost of the patent and other costs such as legal fees and administrative fees. Okay, such as legal fees and administrative fees. So see, legal fees and administrative fees should not be capitalized. Okay, legal fees and administrative fees should not be capitalized. So what the risk is over here is that they have added the wrong cost to the patent. Okay, they've added to the wrong cost to the patent. Okay, so what is the risk is they have not they've calculated the wrong cost to the patent. These costs should not be added, but legal fees and administrative fees should not be added. So the risk is that they have added the wrong cost to the patent and they would have done the wrong kind of amortization. Okay, wrong cost. Legal fees and administrative fees should not be added to the cost of the patent. They would have audited, they have added it. So that is a mistake over here. So as a result of this mistake, that is why the patent cost is a risk. Why? Because they have added the legal fees and administrative cost. So what we can do, what is the impact of this? Assets and profits are bigger than they really are. Your assets and profits are bigger than they really are. Okay, the assets and the profits are bigger than they really are. So they are overstated. Your assets and profits are overstated because of the legal fees and admin fees that you wrongly added. So what is this plan over here? That as an auditor, you have to check what costs are capitalized, and you have to check IS 38 rules. Also recalculate the amortization because the wrong asset cost, that means wrong amortization also. So what you have to do is first obtain a breakdown of the capitalized cost. Get a breakdown of the cost. Check what costs were capitalized. Verify only allowable cost should have been capitalized. Agree purchase cost to the contract and invoices. Next, what you have to agree the purchase cost to contracts and invoices and recalculate the amortization. What you have to do is recalculate the amortization based on the patent's useful life. Recalculate the amortization based on the patent's useful life. Recalculate the amortization. Obtain a breakdown of the capitalized cost. A. Verify the allowable cost under IAS 38. Agree purchase cost to contracts and invoices and recalculate the amortization based on the patent's useful life. Recalculate the amortization based on the patent's useful life. So firstly, obtain a breakdown of the cost. Verify all the allowable costs under IAS 38. Agree purchase cost to contracts and invoices and recalculate the amortization based on the patent's useful life. Recalculate the amortization based on the patent's useful life. Okay, so first you do is obtain a breakdown of the capitalized cost, verify the allowable cost under IAS 38, agree purchase cost to contracts and invoices. So firstly you obtain a breakdown of the capitalized cost A, verify the allowable cost, and see once you get the breakdown, see if correct costs have been capitalized, and ensure recalculate the amortization and just see if the correct amortization has been charged. So that is the problem with the patent costs, that legal fees, administrative fees they have added, but it is not right. These costs should not be capitalized, these should be expensed. Okay. And along with that, they are saying that the amortization also could be wrongly calculated. So you might have to recalculate the amortization. What you have to also do is recalculate the amortization. Okay. What you have also do is recalculate the first new client we have got, then second risk we have found out. So in case of new client, we got the risk, right? We looked into all the risk with the new client over here. Right. So what is the risk? The new client, new audit client is a risk. Why is it a risk? Because you are not familiar. And what is the impact? What is the impact? What is the impact? There is a high detection risk. Yeah. What is the impact? Yeah. Hi, Sharon. Good morning. Yeah. Where are you, buddy? Have you reached? Yeah, okay. So we'll have class at 12:30, buddy. I'll see you at that time. Okay. So you got into your PG? Okay. You can sit on top. We'll have a class at 12:30. I'll see you that time. Okay. Great. Thanks. Okay. Next is what is the risk here? There can be higher increased detection risk. This is the impact. Increased detection risk is the impact. And what is the problem to this? Increased detection risk is an impact. And what is the problem? What is the solution over here? You can send an experienced team. That is the solution. And along with that, you can give adequate time. Okay. And opening balances you can check if you ensure that the opening balances are correct. Okay. So this is the new client. We got it over here. We got an idea. New client. We got an idea. New client. We got an idea over here. New client. We got an idea. New client. We got an idea. New client. We got an idea. Okay. New client is done. Next, we look into legal fees and administrative cost. Next, we're looking into legal fees and administrative cost. Okay, legal fees. That's the second mistake here, that your legal fees and administrative cost should not be added to the cost of the asset. They should not have been capitalized. Okay. There is that the costs such as administrative cost and negotiating contract have been capitalized. They should not be capitalized. Okay. They should not have been capitalized, but they have. Okay. So there's also a risk that the amortization cost has not been accounted and calculated correctly. There's also a risk that the amortization cost has not have been calculated correctly. These are the two mistakes, right? So there's a risk that your intangible and profit both will be overstated. Okay. So what the patent cost is a risk. Why? Because of the reasons written below. And what is the impact? Intangible assets. So what happens here now? The audit team should obtain a breakdown of the total amount. As an audit team, what you should do, obtain a breakdown and check whether the costs that have been included in as per IS 38. Okay, you might also just recalculate the amortization and ensure that the correct amounts have been taken and recorded in the correct period. Okay, so this is pretty much the action that you can take. All right, slowly moving on to the third one here. That in order to finance the project, S has obtained an interest-bearing bank loan of 2.5 million. Okay, the bank loan is payable in the annual installment. First installment is due to be paid. So they have taken a bank loan. So now why can this be a risk? Because they would have not recorded correctly as current liability and non-current liability. So see, some amount they have to pay this year, some amount they can pay later. Okay, there's a new year and there's a risk that the classification is would not have been done properly. Okay, the classification have not been done properly. So current and your non-current liabilities may be misstated. So your current liabilities and non-current liabilities may be misstated. Okay, so current and non-current liabilities may be misstated. So they have taken a new loan, right? That is a risk. Why is it a risk? Because there's no proper classification, right? There could be a classification error. So what you have to do is recalculate the split and ensure that the classification is in accordance with the local standards. Okay, this is the first risk. Whenever there's a new bank loan, some should be current, some should be non-current. So you have to ensure that some of the split is done correctly, that some part of the loan is recorded as current, some part of the loan is recorded as non-current, right? The split should be done correctly. So what you can do as an audit team is recalculate the split and ensure that the classification is done properly in accordance with the local legislation. Okay, that is the first risk. The second risk over here is that the finance cost has not been put in the P&L correctly. Okay, it might be understated. There is risk that the finance cost has not been put in the P&L correctly. Next risk is the finance cost have not been put in the P&L correctly. The finance cost has not been put in the P&L correctly. So what you have to do is recalculate. What you have to, the finance cost should be recalculated. Okay, and you have to check. First you recalculate and whatever answer you get, you check it with what has been recorded, and if there are any differences, you have to check with the management that why are the differences. Okay, first is the split is wrong, second the finance cost may be incorrectly recorded. First is that the split is wrong, second is the finance cost is incorrectly recorded. Okay, first is the split is wrong, second is the finance cost is incorrectly recorded. Okay, first is the okay first is the finance cost. Okay, first one is the finance cost. Okay, first is the finance cost. The finance cost is not correctly recorded. And first is the split, second is the finance cost. Right? We have to just do the split again just to see the split is according with the local legislation. And second, the finance cost may not have been recorded correctly or they have been omitted from the P&L account. Right? The finance cost associated with the loan has been omitted from the P&L account. Right? It has been omitted from the P&L account. So what you have to do is recalculate the amount and the interest rate. Recalculate the interest cost, take the loan amount and the interest rate and recalculate it. Okay, and recalculate it. Recalculate it based on the loan amount and the interest rate. What you can do is you can recalculate. Based on the loan amount and the interest rate, what you can do is you can recalculate. Based on the loan amount and the interest rate, what you can do is you can recalculate. Based on the loan amount and the interest rate, what you can do is you can recalculate. Okay. Yeah. Huh. Yeah, okay. So that is about this. Recalculate the interest amount and again make sure that the split is done correctly in accordance with the standards. Okay. The payable ledger has discovered a batch of invoices that has been miscoded. So there was a batch of invoices that were miscoded. Right? There was a batch of invoices that were miscoded. A batch of invoices were miscoded. So you've identified the risk. A batch of invoices were miscoded. Okay. Miscoded invoice is the risk. Why is it a risk? Right? It is a risk because there might be more invoices similar to this that would have been miscoded. Right, which have not been identified. There may be other miscoded which are still yet to be identified. Right, there may be way more other invoices which may be not correctly identified yet. And what is the impact of this? Right, because of this, what would have happened? Your payables and purchases would be understated. Right, there's a risk that your payables and purchases would be understated. Right, the risk is that your payables and purchases would be understated. Your payables and purchases would be understated. That is the risk. What is the risk? Your payables and purchases would be understated. Okay, your payables and purchases would be understated. So what is an action that we have to take? The action we have to take is Okay. Discuss what we have to do as an action. Discuss the issue with the management. Determine how the error occurred. So what we will do is that discuss discuss the matter relating to the misquoted invoice with the management. Right. We'll discuss the matter with the management to understand how the matter has occurred and what exactly happened. So first you're discussing to get an idea. Okay. And first you're discussing to get an idea. That's the first thing. You're discussing to get an idea. Okay. Then what you can do is detailed testing of trade payables balance, including a review of supplier statement reconciliation. Second is a detailed testing of the trade payables. Next, what you can do is a detailed testing of the trade payables. Next, what you can do is a detailed testing of the trade payables balance, including a review of the supplier statement reconciliation. Okay. Detailed testing of the trade payables balance, including a review of the supplier statement reconciliation. So what you can do is detailed testing of the trade payables balance, including a reconciliation, should be carried out, right? Just to make sure that the properly all the invoices have been recorded, all have been included. So what you're doing over here, talk to the management firstly. Second, check the supplier statements and test the payables to find any missing one. Check supplier statements. Okay, supplier statements you can check the supplier statements also. See, supplier statement is something that the supplier sends you with all the list of the invoices, how many ever times you have taken anything from them. Check that and check your invoices also, right? You check a statement from the supplier that will come from the supplier and check your own in-house invoices, right? You compare the two, check your own in-house document and compare the two. So detailed testing of the trade payables balance, including a review of the supplier statement. So see, supplier statement is the statement that the supplier gives. It has a list of all the invoices that you have to pay him for. Okay. And reconcile it with your own internal record and just make sure that everything has been properly recorded. Okay. And make sure that everything has been properly recorded. So the risk is miscoded invoices. Why is it a risk? Because there might be some more invoices which are miscoded, which have not been identified. What is the impact of that? Purchases and payables might be understated. So what you can do is firstly discuss with the matter with the management what exactly happened, how it all went about, and then do a detailed testing of the payables balances and also get the supplier statement. See, supplier statement is given by the supplier. It has a list of all the invoices. So get that supplier statement, check it with your own internal records, and make sure that all has been correctly recorded. Right? This as an auditor you can do. These are the things that you can do as an auditor. Okay, these are the things you can do as an auditor. Okay, these are the things that you can do as an auditor. Okay, so we finished these first four, guys. Okay, and is a new audit client, patent cost, new bank loan, and misquoted invoices. Okay, so we are halfway through. We had to find eight. We have done four. Okay, so let's just quickly get through this here. Richard, just take us through the issue with the new client. What is the issue with the new client? Why is it a risk?
New clients, they have limited knowledge about the business.
Okay, and what will be the
They don't
impact?
know about the internal controls and transactions which is going on inside the company or the business.
Okay, done. And what is the impact?
We should use higher detection risk procedures.
No, higher detection risk. No, that is action is separate. See, impact is separate, action is separate. Impact is there's higher detection risk. What is an action next? What action can an auditor take?
We have to assign experienced team members accordingly.
Hmm. Ensure that an experienced team members are there accordingly and they can take over things. Okay. Geeta, are you back? Can you hear me?
Yes, sir.
Okay, let's go to the second one, Geeta. What have you understood in the second risk here?
So in this one, it said all costs have been capitalized,
Mm-hmm.
and like the negotiation and administration costs could have incorrectly been capitalized. So our intangible assets and profits could be overstated.
What we can do?
Auditors need to obtain a breakdown, the capitalized cost, and verify.
Okay. I'll verify and ensure that all the correct costs have been included. Yeah, it is about this. Okay, good job. All right. Okay, so we have halfway through. We had to find eight risks. We have at least done with four. Okay, so we'll obviously look a little more, but has come halfway through the answer, and you should just consider that have we understood all the parts here. Okay, misquoted invoices. So there's a risk that there might be more which are unidentified here. Payables and purchases are understated. That is the impact. And what is the solution to this? We will discuss the issue with the management and determine how the new errors occurred. Okay, we will discuss how the new errors have occurred. Okay, you'll see how the new errors have occurred. That is very important. How the new errors have occurred. And inventory damaged by fire. Inventory worth 1.1 was damaged by fire. Okay, we'll get into this now. Okay, so these are the four tests that we have done up until now. It's completed. Next, let's look into the next risk here, inventory damage. Very important. Okay, so we'll pick it from the case first. These errors have been corrected, but investigation is still going on. There was a fire and result in damaged inventory. So see, some are totally destroyed, you have to write it off. Some are partially destroyed, their value would have come down. And you might also want to make an allowance now. Okay, for if any will be recorded in this case, so we'll have to consider that. So damage inventory, so you have to write down the value of the inventory. See, some are totally gone, so you write them off. Some slightly gone, then you have to write down its value because still slightly it's burnt only. Okay, and they are also telling that 1.1 has to be completely written off. Okay, 1.1 has been completely written off. So firstly, inventory damage by fire is a risk. Why? Because now what they have to do is they might have not have written down. Right? They're saying is 1.1 is completely damaged and then you have to write it down. So there's a risk that that might not have been written off. So what happens over here is inventory is overstated and cost of sales is understated. Your inventory may be overstated and cost of sales is understated. Okay, and what is the solution to this? Discuss discuss the management process for identifying the damaged inventory. Okay, so first of all, you ask the management, how do you find out the damaged inventory? Right? You review the inventory count results also, attend the year-end inventory count and ensure and verify that any damaged item has been written off. You attend the inventory count also. As an auditor, you attend the inventory count and you ensure that no, you attend the inventory count and you attend the inventory count and you assure that there is no goods that have been damaged and that are still included in the inventory. Okay. So there are goods that are still they're damaged and still not included in the inventory. There are certain goods that are damaged and they're still not included in the inventory, right? They should not be included. So you can attend the inventory count as well. As an auditor, what you can do is you can attend the inventory count as well and just make sure that those goods are not been included. Okay. Next, the damage has not been replaced and there is sufficient inventory. The directors have raised a claim against insurance company to cover the full cost. Although no confirmation has received, the director has confident and included as a receivable. So you cannot include as a receivable because see they have not responded only. How do you know will you get it? Right? How do you know you will get the money? You have just told them they have not responded anything. So max to max, if it is highly probable, you can just record a contingent asset, but you cannot record an asset until it's reasonably certain, it's virtually certain. Okay, so they have recorded a asset, so your assets are overstated currently. Okay, and which is your receivables. Okay, your assets are overstated currently. Okay, so review the correspondence with the insurance company and see if it is virtually certain. If not, please tell them to remove it from the receivables. Please request to remove it from the receivables. Okay, so ESCO has recognized a 1.1 insurance claim under the insurer. Contingent asset has only been recognized when the receipt is an asset can only be recognized when it's virtually certain. So okay, an asset can only be recognized when it is virtually certain. Only if it's probable, you can recognize a contingent asset. When it's virtually certain, only then you can recognize an asset. Okay. So here asset should only be recognized when it is virtually certain. Okay. Unless if it's highly probable, max you can do is you can recognize only if it's probable, insure a contingent asset and you make a disclosure. Okay, so this I will add it here also, you'll get a good clarity. Okay, only if it's probable, you ensure a contingent asset disclosure is made. Okay, when can you recognize a contingent asset? Only when it is probable, right? Only when it is probable, a contingent asset disclosure should be made. Only when it is probable, a contingent asset disclosure should be made. Okay, only when it is probable, a contingent asset disclosure should be made. Okay. Only when it is probable a contingent asset disclosure should be met. Okay. Only when it is probable a contingent asset disclosure should be met. Only when it is probable. Okay. Only when it is probable a contingent asset disclosure should be met. Okay. Only when it is probable a contingent asset disclosure should be met. So that is about the insurance claim. Only when it's probable a contingent asset disclosure should be met. Next we look into a staff bonus. Okay. Next we look into a staff bonus. What about staff bonuses? Receive staff bonuses if they meet the sales target. So again, whenever you have a contingent payment, that means if you meet the target, we'll pay you extra. People will manipulate. So you have to have a lot of professional skepticism, right? It's an incentive to create fake sales, right? This is an because they're getting a bonus, it's an incentive to create fake sales. So you'll see your revenue and your receivables may be overstated. Why? Because of fictitious sales. They were might just fake sales they would have made just to get a good bonus. So make sure that you're doing a good cutoff testing and maintaining a good professional skepticism, right? And also review any post-year end sales that were cancelled after the year end, just because they did it just to get the bonus. Any returns that and sales that were cancelled after the year end. Okay, any returns that they got or sales that were cancelled after the year end. Okay, so in case of staff bonus, in case of staff bonus, what you do is, in case of staff bonus, what is your focus? In case of staff bonus, you have to ensure there's an incentive to record fictitious sales or accelerate revenue recognition before the year end. So what is really important in case of staff bonus? There should be an incentive to record fictitious sales. There should be an incentive to record fictitious sales. In case of staff bonus, an incentive to record fictitious sales. They have an incentive to record fictitious sales. Your revenue and receivables may be overstated. What you have to do is maintain a lot of professional skepticism. What you have to do is maintain professional skepticism and review post year end sales returns and cancelled orders. Review post year end sales returns and cancelled orders. Okay, what you have to do is review post year end sales, uh, do cut-off testing and review post-year end sales and any cancelled orders also. Any cancelled orders, review them. Were there any orders that were cancelled? Were there any orders that were cancelled? Okay. Were there any orders that were cancelled? All right. Were there any orders that were cancelled? Very important. Next we look into is the discount. Okay. Next we look into is the discount. So what happens is whenever you're getting a payment based on meeting a target, you have an incentive to do a fraud. What you have is you have an incentive to do a fraud. What you have is an incentive to do a fraud, right? That's the problem. You have an incentive to do a fraud. Okay, you have an incentive to do a fraud. You have an incentive to do a fraud in this case. Okay, so you have to just be more alert and make sure you do the testing just to see how many sales that you had made initially were returned after the year end that were fake sales. Okay, next we look into the discount. Right, a regular customer discount of 10% which are negotiated and documented by the sales directors. Okay, which are this year is needed to monitor. They have recorded separately as an expense. So this you cannot do. You have to subtract the discount from the sale. You cannot record discount separately, right? You cannot record discount separately. So your COGS and revenue both are overstated. So if there is a discount that you're giving, you subtract it from the selling price only. Okay, subtract it from the selling price. So discuss the treatment with the management, recalculate the discount for a sample of sales, and request the reclassification of discounts. Okay, and request the reclassification of the discount. The trade discounts have been recorded as an expense instead of being deducted from the revenue. Okay, your trade discounts have been recorded as an expense instead of being deducted from the revenue. Okay, so in case of discounts, the discounts have been recorded as an expense instead of being deducted from the revenue. So what you have to do, revenue and cost of sales are overstated and discuss the accounting treatment with management, recalculate the discount for a sample of sales as well. Okay, so these are the things that you're looking into discounts. That discounts have been recorded as an expense instead of being deducted from revenue. Revenue and cost of sales are overstated and discuss the accounting treatment with management, recalculate the discounts for a sample of sales and review the revenue and cost of sales and request the reclassification. Tell them to request the reclassification. What you have to do is basically whatever discount you got, subtract it from the cost of, subtract it from the revenue. Don't record discount separately. You should not record discount separately. Just take the discount, remove it from the, take the discount and just remove it from the, take the discount and just remove it from the sales value. That is the correct treatment. So here, they are recording it separately. That's a problem. Yeah, here they are recording it separately. That's a problem. Okay, here they are recording it separately. That's a problem. Okay. Next we'll look into is credit control. The credit control department has been off work and there has been replaced by an inexperienced temporary manager. Okay. An inexperienced temporary manager has happened, and as a result, ESK has not been monitoring the aging of receivables, and also the credit terms are 30 days. They have started becoming greater than outstanding from 90 days or more. That is another problem over here. So an inexperienced credit control manager has replaced the previous manager, and the receivable collection period has also increased. That means you're collecting slowly and slowly. So see, the risk is that some receivables you will never get only now. Your receivables may be overstated. See, some people, if they have not paid for 90 days, they might just not pay. Yeah, okay, they might just not pay now. So what you have to do is discuss the credit control procedures with the management, review the age receivables, and perform post year end testing. Okay, and review the post year end testing. Next, assess whether an additional allowance for received is required. Assess whether an additional allowance for receivable is required. Assess whether an additional allowance for receivable is required. Okay. Discuss credit control procedures with management. Discuss credit control procedures with management. First is discuss the credit control procedures with management and review aged receivables. Perform extended post year end and cash receipt testing and assess whether an additional allowance for receivable is required. Now, okay, assess whether an additional allowance for receivable is required. So, firstly, discuss credit control procedures with the management. With the management, you discuss the credit control procedures, review the age receivables, perform extended post-year end testing, and assess whether an additional allowance is required. So sometimes an additional allowance may be required. Okay, sometimes what will happen? An additional allowance may be required. To discuss the credit control procedures with the management, right? That how will you collect this money? How are you planning to collect this money? Okay, how are you planning to collect this money? Assess whether an additional allowance or receivables is also required. You have to ask whether an additional allowance or receivables is required. Next is tax investigation. Yeah, okay. So first, what has happened over here? The main guy, the credit controller, has been replaced, and there's some temporary guy who has come, and he's inexperienced. So as a result, also what we have noticed that he's not collecting the debts properly. It's been more than 90 days. Some people have not paid. So what is the this is the reason why there is a risk. And what will be the impact of this? Your receivables may be overstated. Some people are never going to pay. So what you have to do is, first of all, you might need an allowance for that. Second, you have to write down your receivables. To discuss the credit control procedures with the management, review the age receivables, perform a post-year end testing to see if someone has paid, and whether and more allowance will be required. So whenever there is you think that people will not pay, you have to create an allowance. So here the allowance may not have been created. Okay. Next is tax investigation. Next is tax investigation. What about tax investigation? Okay. Now what about tax investigation? So here what has happened is during the year, informed tax authorities that it are under investigation, has appointed tax consultant who has advised and estimated there would be a penalty of 0.6 million will be payable. The directors do not need to record anything in the financial. The directors do not intend to record anything in the financial statement until the notification is provided by the tax authority, which is due on 31st January. So even if it is possible, they should give a contingent liability. So here they're saying nothing they are recording. Now that is wrong, right? So there's no provision or disclosure. If it is probable, make a provision. If it is possible, make a provision. But something has to be done. So either your provisions are understated, either your disclosures are incomplete. Either your provisions are understated or your disclosure is incomplete. So what you can do is obtain a correspondence from the tax authorities. First thing, discuss the matter with the management, review advice from the tax consultant, and then assess the likelihood and the amount of the obligation. Okay, and ensure an appropriate provision and disclosure has been recognized in accordance with IAS 37. Okay, so firstly, obtain the correspondence from the tax authorities. From the tax authorities, obtain a correspondence. From the tax authorities, obtain a correspondence. Okay, from the tax authorities, obtain a correspondence. Firstly, from the tax authorities, obtain a correspondence. From the tax authorities, obtain a correspondence. Okay, from the tax authorities, what you have to do is you have to obtain a correspondence from the tax authorities. Okay, assess the likelihood and the amount of the obligation. Ensure an appropriate provision and disclosure has been recognized. So see, first of all, whenever a money expense is about to come, if it is probable, record a provision. If it is possible, record a contingent liability. One of the two things should be recorded at least. And if it is virtually certain, record a liability. But at least one of the three should be recorded. Here the case is nothing they have recorded. So either your provisions are understated or your disclosures are incomplete. So what you can do is obtain a correspondence from the tax authorities. Discuss the matter with the management, right? Review the advice and request them to make either a disclosure or either a provision, right? You have to request them that either you make a provision, either you make a disclosure. Something you have to do. Something you have to be. do. Something has to be done. You cannot just leave it like that. Okay, something has to be done. You cannot just leave it like that. Okay, something has to be done. You just can't leave it like that. That's a problem. Right? Now that's a problem. You just can't leave it like that. That's a problem. Okay, something has to be done. You just can't leave it like that. Okay, and that is the end to the question of ESK. Okay.